equity or gold? Man, that's one of the biggest puzzles for any investor, right? Well, today we're going to solve it, but not by picking a winner. Instead, we're going to figure it all out using a really simple but powerful analogy, thinking of your portfolio like a car with an engine and a shock absorber. So this is the question everyone asks. Which one is actually the better long-term investment? You hear it all the time. Gold is safe, but stocks give you better returns. It feels like this constant tug of war, and honestly, it can leave you kind of paralyzed, just wondering, which one is the winner? But what if we're asking the wrong question altogether? The real key to smart investing isn't about picking a winner. It's about understanding that equity and gold have completely different jobs to do inside your portfolio. All right, first up, let's talk about the powerhouse of our portfolio, equity. When it comes to equity, its job is super simple: create wealth. This is the part of your portfolio that's designed to push you forward, to really grow your capital over the long haul. It's the powerful engine that's going to drive you towards your financial goals. And hey, the numbers totally back this up. If we look at the long-term data, specifically the compound annual growth rate, or CAGR, you can see equity has historically delivered returns around 13%. Gold, on the other hand, is closer to 11%. Now, that 2% might not sound like a huge deal, but trust me, when that compounds over decades, it makes a massive difference. That's the fuel for real wealth creation. So what's the perfect weather for this engine? Well, equity absolutely loves a healthy, growing economy. When companies are doing well, making profits, and expanding, the value of their shares tends to go up. It's directly tied to economic progress.
Okay, so we've got this amazing growth engine. But what happens when the road gets all bumpy and rough? A powerful engine isn't much good without a decent suspension system, and that brings us to our shock absorber, gold.
And that is exactly what gold is for. Its job is pure wealth protection. If equity is the engine pushing you forward, gold is the suspension system. Its purpose isn't speed, it's to give you a smooth, stable ride, especially when the market gets rocky. Think about it. Gold really has its moment when things get a little crazy. During times of high uncertainty, when inflation's creeping up, or when there are big global risks on the horizon, investors often run to gold. It's seen as a safe haven, a reliable store of value. It's basically a safety net for your entire portfolio. And this is where you can see how they're just perfectly designed to work together. Equity gives you that high growth potential, but it's volatile. Those are the bumps in the road. Gold, on the other hand, is stable and way less volatile, which makes it the perfect counterbalance. They aren't fighting each other, they're partners. Okay, so we get the parts. Now, how do we actually build this thing? How do you assemble a portfolio that gives you a ride that's both powerful and smooth? So let's just hammer it home one more time. Equity, that's your engine. It's all about growth. And gold, that is your shock absorber. It's there to protect the wealth that your engine is busy building. So you're probably asking, okay, how much shock absorber do I really need? Well, there's a really handy rule of thumb that a lot of experts suggest, the 5 to 10% rule. You can see it right here. We're not talking about half your portfolio. We're talking about dedicating a small but really important slice, about 5 to 10% to gold. The vast majority, that other 90%, stays invested in your growth engine, equity, and other assets built for creating wealth. And getting this balance right is absolutely crucial. Think about it. If you have way too much gold, your vehicle is going to be incredibly smooth, but also very, very slow. You're giving up all that long-term growth. But if you have too little gold, well, you've got a powerful engine, but you're going to feel every single bump during a market downturn. It's going to be a painful ride. All right, last part. Let's talk about the roadmap, and more importantly, the potholes to avoid. Knowing about these common mistakes can really help you stay on the right track. Okay, here are 3 massive traps investors fall into all the time. First, they get scared and put way too much money into gold for safety, which basically turns their sports car into a golf cart. Second, they avoid equity completely because they're afraid of the bumps, which means they never even leave the garage. And third, they chase whatever did well last year. That's like trying to drive forward by looking only in the rearview mirror. It just doesn't work. Look, if you remember just one thing from all of this, let it be this simple idea. Equity is there to build your wealth. Gold is there to protect it. A smart investor doesn't choose one or the other. They use both, strategically. And that brings us right back to where we started, but now with a totally new perspective. The whole debate, it's over. It was never a competition. The real question now is about strategy. It's the question you should be asking yourself. How are you going to combine your engine and your shock absorber to build the perfect vehicle for your financial journey? Just a reminder, this has been for educational purposes only. Mutual fund investments are subject to market risks, so please be sure to consult a qualified professional before making any investment decisions.